Over the past 5 years, the Nifty PSU Bank Index has delivered a staggering 32% returns per year on average. Now, if you compare that with Nifty 50 or Nifty 500, which have given 10% and 15% respectively average on year. So the question is, what is this Nifty PSU index actually? PSU banks are basically the big government owned banks in India, like State Bank of India, Bank of Baroda, Indian Bank, etc. All 12 of these form the Nifty PSU index. And get this, in just the last 6 months, the total market cap of these 12 banks has jumped from 6 lakh crores to 20 lakh crores. That's a massive jump. So why is this important? Because it shows that there is an increased interest in these banks. Earlier, these banks had a huge headache called NPAs, non-performing assets. In simple words, if I want to explain it to you, that's money that they lent out to borrowers who stopped repaying. Hence, they are called bad loans. Those days are mostly over. The banks have cleared up all their books. Asset quality is much better. Gross NPA is under 2% and net NPA is around 0.4%. They are making record profits and only the well-managed banks with strong fundamentals are gonna benefit now. These PSU banks currently are trading at very cheap prices compared to what they're actually worth. The sector is available at around 1.2 times price to book ratio. Many individual banks are still below 1.5x. So the question which arises in your mind is, what is this PB ratio? PB ratio just tells you how expensive a bank stock is compared to the actual money the bank owns. The formula comes up to PB ratio is equal to current stock price divided by the book value. So I'll give you an example for you to understand. So imagine there's a small bank. It has a book value of 100 crores. That means if you sold everything the bank owns and paid all its debts, 100 crore would be still left. Imagine there are 10 crore shares. So the book value will come to 10 rupees per share. Now the stock is trading at 15 rupees per share in the market. Hence, PB ratio will become 15 divided by 10, which is 1.5x. So you might question, what does it even mean? You are paying 1.5 for every rupee of the bank's actual net worth. If the PB is 1x, then you are buying the bank at its exact book value. If it is less than 1x, then you are buying it at a discount. If the PB is 2x or more, you are probably paying a premium. That means that the stock is currently expensive. Now that you know what PB ratio means, let's compare PSU banks with private banks. This is where things get really interesting. Private banks like HDFC or Axis are currently trading at 2x to 4x PB. But PSU banks, they are much cheaper, even though they're showing solid profits, high ROE. So if PSU banks have cleared up their balance sheets and are making record profits, the obvious question is, why are they still trading so cheaply? Sounds almost too good to be true, right? Well, that's because there are a few risks the market is worried about. As we all know, no business is risk-free. Here are the main worries: deposit war and NIM pressure. Banks are growing their loan growth at around 15% faster than they're getting deposits, which is currently at 13%. To attract more deposits, they will offer higher interest rates on fixed deposits. This squeezes their margin, the profit they make from the difference between what they charge on loans and what they pay on deposits. Banks that keep deposit costs low might usually suffer. Secondly, we have geopolitical shocks and oil prices. India is a oil importing country. If oil prices shoot up to $100 per barrel, it can cause inflation. Higher prices hurt businesses, and these people who have borrowed money will find it difficult to repay back loans. This could create fresh bad loans. The interest rate. The RBI has kept the repo rate at 5.25% because of inflation worries. Higher rates makes loans more expensive for borrowers. Also, if the 10-year government bond yields stay above 7%, banks can face losses on the government bonds. Let me give you a simple example to understand. Suppose a bank bought a bond yielding 6.5%. Now new bonds give 7.2%. The old bond becomes less attractive, so its market price drops. Comfortable with these risks, the next question is, how should you actually invest? Should you buy the whole sector or pick individual stocks? The safest way is through the Nifty PSU Bank Index or its ETF. You get exposure to the whole sector without putting all your money in one basket. If you have a higher risk appetite and want to pick individual stocks, here are my top 3 conviction ideas. We have State Bank of India. If you want the safest bet, it's obviously SBI. It is India's largest bank, has the strongest franchise, trading at around 1.5x PB. Expected net profit for FY26 is around 80,000 crores with an ROE of 15.4%. Next, we have Bank of Baroda. It is a safe large cap choice. Expected FY26 profit is around 20,000 crores. Its loan book is well diversified with both international loans growing faster at 24.4%. ROE is at 15.37% and is trading at a very attractive 0.8x PB below its book value, which gives a good margin of safety. Have Indian Bank, the mid-sized performer. If you're looking for the fastest improving bank, Indian Bank stands out. This one is shining with exceptional ROE of 20.76% for FY26. Almost zero NPA, excellent asset quality. They have a massive presence on the digital side with 93% transactions are digital, which keeps their cost low. Trading at around 1.42x PB looks very good for the long term. That's my opinion. I'm bullish on the PSU banking sector for 26 to 2028 because of its undervaluation and improving fundamentals. But I focus only on quality names. If you feel picking stocks feels overwhelming, just go with the PSU Bank Index or ETF.